Hello and welcome to GBA1 Module 2. This week we will be exploring risk concepts and the implications to employee benefit planning. Our learning objectives for this week are to 1. Distinguish among the concepts of risk, peril, and hazard. 2. Explain the varied methods utilized to either control or manage risk. 3. Discuss the advantages and disadvantages when using insurance in an employee benefit plan. 4. Describe the characteristics of an insurable risk. And 5. Describe the characteristics of the group technique in providing employee benefits and the settings for a self-funding approach. To get started, let's define the term risk. Basically, risk means uncertainty when thinking in terms of loss. It relates to the balance in determining what a future loss may be with how much it would cost. Loss refers to the occurrence of a decrease in value. It may be a loss to the employer or to the employee when thinking of it in terms of employee benefits. Some examples of this would be illness, death, disability, unemployment, or simply the cost of medical bills. Related to the term risk are the terms peril and hazard. While both are insurance terms, just like the term risk, they differ from risk. They are used largely in respect to property and liability insurance. However, they also have application in terms of employee benefit planning with such factors as life and health insurance. A peril is the cause of personal or property loss, destruction, or damage. A hazard is a condition that increases the probability of a peril occurring or that can increase the loss in the event of a peril. For example, of peril, think of property to include things like fire and floods. Personal losses can be illness and bodily injury. Hazards can be of three types: physical, moral, and morale. Those last two often get confused because they're spelled very similarly, but moral and morale hazards are distinctly different. For example, machines without safety guards are a physical hazard. Dishonest or unethical behaviors such as filing a fraudulent medical claim is a moral hazard. Acting carelessly, such as failing to lock up valuables, would be considered the morale hazard. So they're distinctly different. So moral hazards are engaging in dishonesty or being unethical, and morale hazards are just being careless. Going back to the term of risk, there are two types. There's pure risk and there's speculative risk. Pure risk has only two alternatives. It is binary. It will either happen or it will not. Speculative risk builds on these two by adding the chance of gain. So pure risk can be subclassified to personal risk, property risk, and legal liability risk. Employee benefits generally deal with personal risks. There are 5 main methods of handling risk. There's avoidance, control, retention, transfer, or insurance. Often they are combined, and a couple of them are used to help best control any risk. The only one mutually exclusive option would be that of avoidance. The best method should consider how economical the option is financially, how it affects the employee, and any governmental mandatory requirements. Going through these risks in a little more detail, avoidance is the perfect choice as risk is never assumed. You simply avoided it. If someone does not want the risk of drowning, they just don't get into the swimming pool. Avoidance is difficult to achieve with employee benefits because people do get sick, they pass away, their teeth decay, and so on. Control is the attempt to prevent or reduce the potential loss or reduce the severity of such risk. Control devices include things like seatbelts and diet and exercise. When it comes to employee benefits, control can include factors such as wellness programs and biometric screenings. The organization puts those in place basically to help control a very negative health situation from arising. Retention means the risk is assumed and paid for by the one suffering the loss. It is often coupled with insurance. An example of retention in employee benefits is the use of the deductible paid by the employee on the health insurance. Especially with our high deductible plans now, employees definitely retain a larger portion of the risk than they used to when we had primarily HMO insurance programs. Transfer is a method that shifts the burden to another party using two types, either insurance or no insurance. For example, a rock climbing gym requires a waiver that transfers the risk to the patron. If they get hurt, the patron has signed a waiver that said that they will assume all the costs of any of the injuries or damage that they have incurred. With employee benefits, transfer is generally done through the use of insurance contracts. So a company will go out and become what we call fully insured, much like with you and your car insurance. You go buy an insurance policy, then the insurance company has the risk transferred to them because they assume the cost of anything that goes negatively. Insurance, which is the last type of control, is the most common technique used in employee benefits. It is used to indemnify victims of losses. In the event of a loss, a reimbursement is made to the one suffering the loss, the sick or injured employee. For instance, if one breaks an arm, then the medical insurance indemnifies them by paying the medical bills. While insurance has the advantage of a known premium cost, an external administrator, and economic leverage, there are disadvantages such as costs to purchasing and administering an insurance plan and the insurer's ability to handle the claims and solve problems. Considerations must be given to a risk to be considered insurable, which include: you have to have a large number of homogeneous risks. The loss should be verifiable and measurable. The loss should not be catastrophic in nature. The chance of loss should be subject to calculation, should be able to calculate it or project it. The premium should be reasonable or economically feasible. The loss should be accidental from the standpoint of the insured, can't be purposeful. Employee benefits have minimum standards for risk. They generally include health and welfare benefits and have controlled measures such as policy provisions, benefit restrictions, and use of reinsurance. Based on the type of benefit, it will be placed on a continuum of insurability. Adverse selection is a major concern with insurance. Usually those with the most risk will want the insurance the most. This is called adverse selection, and it can be financially detrimental to an insurance program. To control for it, such tactics as inserting pre-existing condition clauses, which has now been greatly altered by the inception of the Affordable Care Act, and also things like suicide clauses in life insurance policies, both can be used. Some organizations choose to self-fund, where they basically pay for the claims, thereby retaining the risk. They still have to conduct the same administration functions as a fully insured plan, so they will contract with a third-party administrator or TPA to perform the functions such as claims administration. That being said, a self-funded plan often has regulatory benefits, making it very worthwhile. To control for catastrophic loss, many organizations will combine self-funding with a stop-loss insurance policy. Stop-loss insurance is a pure insurance policy that will kick in after a claim gets to a specified amount, say $50,000. At that point, the self-funding coverage from the company funds ceases and the stop-loss insurance company picks up the payment of the claims. The current and most widely used technique is that of the group technique, which looks at coverage from a group perspective rather than from an individual perspective. The group technique can be very beneficial to avoid the implications of adverse selection, as it operates under the premise of the law of numbers, where the risk is spread across many lives rather than just a few. This also includes the costs. A main characteristic of this technique is that only certain groups are eligible. For instance, it's created for a specified group of people, all people working for XYZ company. There has to be a steady flow of lives and a minimum number of participants, as insurance is factored again on that law of numbers. There must be an established minimum number of participants, and they are subject to eligibility requirements. This technique sets maximum limits of coverage per each person, and there is generally an automatic determination of benefits based on some categorization, such as they're salaried or hourly, or they're in certain managerial positions, or what have you. The group technique has some type of centralized administration for efficiency. It's very important to understand the concepts of risk and the group technique when you're entering into the benefits realm, so that the best design can be put in place that will protect both the monetary interests of the company and of the employee. On to Module 3, an exploration of group health plan structures.